Ray Dalio just said something that should make every person with money in the stock market stop and think. He said AI is eating everything and it might eat itself. Not a journalist, not a podcaster, the man who manages over $120 billion. The man who predicted the 2008 financial collapse when almost everyone on Wall Street was saying everything was fine. That man looked at the current AI market and used the phrase, eat itself. Most people heard that and moved on. But if you understand what Dalio actually means by it, and we are going to break that down completely today, you will never look at your AI investments the same way again. And here is the thing that nobody is connecting. There is a factor sitting right now in China that could make everything Dalio is warning about happen faster and harder than most Western investors are even considering. We will get to that. Because once you understand it, the urgency of this conversation changes completely. So stay with this, because by the end, you will have a clear framework for exactly what is at risk in your portfolio right now and what Dalio says you can actually do about it. Let us start with the most important distinction Dalio has ever made about technology investing, because this single idea explains everything. The dot-com crash, the railroad bubble of the 1800s, and what is happening right now with AI. When people buy AI stocks today, they believe they are betting on the technology. They are not. They are betting on specific companies. And there is a giant difference between those two things. Think about that for a second, because it sounds obvious until you realize almost no one is actually acting like it is true. The internet was real. Nobody serious disputes that the internet transformed civilization. And yet the vast majority of the companies built on top of it in the late 1990s were completely wiped out within a few years of the crash. The technology kept going. Amazon kept going. Google kept going. But the hundreds of companies that investors poured money into during the bubble years, gone. The technology survived. The companies did not. Here is the twist. Most people miss when they hear this history. The investors who lost everything in the dot-com crash were not stupid. They were not uninformed. Many of them were right about the technology. They correctly saw that the internet would change everything. They were just wrong about which companies would capture that value. And that distinction, being right about the technology but wrong about the company, is exactly the mistake Dalio believes is being repeated right now at an even larger scale. Dalio has studied this pattern going back 500 years. He is not describing a theory. He is describing something that has repeated itself so consistently across so many different technologies and so many different eras that calling it a pattern almost undersells it. It is closer to a law. And right now, he is watching it set up again with artificial intelligence. But before we go into what he sees, it is worth spending 30 seconds on why Dalio's warnings are different from the endless parade of market pessimists you can find on any financial channel. Because this is not a man who sits in a room and theorizes about crashes. This is a man who was destroyed by one. In 1982, Dalio was absolutely convinced a depression was coming. He went on television. He told his clients. He positioned his entire fund around that prediction. And he was spectacularly wrong. The economy recovered, markets went up. His clients left. His fund nearly collapsed. He had to borrow money from his father just to cover his basic bills. He had a wife and 2 young children and no clear path forward. That failure broke something in him that needed to be broken. The certainty, the belief that he could simply predict what would happen and bet everything on it. What replaced it was something more durable, a commitment to studying patterns instead of making predictions, to understanding what has happened across 500 years of history rather than betting on what might be different this time. He is not warning about AI because he thinks he knows exactly what will happen next. He is warning because he has seen this specific pattern before, many times, and it has never ended differently. Here is what makes this moment different from other bubble warnings you have probably heard. Dalio is not saying AI will fail. He is saying the opposite. He believes the technology is genuinely transformative. He believes it will change how human beings live and work in ways that are probably beyond what most of us can currently imagine. He is not pessimistic about AI. He is pessimistic about the assumption that transformative technology automatically translates into profitable companies. And that distinction is everything. Because if you are holding AI stocks right now, directly or through index funds or through a retirement account, you are not holding AI, you are holding specific companies with specific debt levels, with specific profit projections, with specific vulnerabilities. And the question Dalio is asking is whether those companies can generate enough real cash flow to justify what investors have paid for them. That is not a philosophical question, it is a financial one, and the answer is not yet clear. Now, before we go further, and this is important, think about your own situation for a moment, not in the abstract. Specifically, do you know what percentage of your portfolio is in companies whose value depends heavily on AI growth projections? Most people do not. Most people own broad market funds or technology funds and assume they are diversified. But when one sector represents a large enough portion of the entire market, diversification within that market stops providing the protection most people assume it does. Keep that thought. We will come back to it. Let us talk about how a bubble actually works, because the word gets used so often that it has almost lost its meaning. People hear bubble and think it just means prices went up a lot. That is not what a bubble is. A bubble is a specific dynamic that involves debt. Here is how it operates in plain terms. Investors get excited about a new technology. They start borrowing money to buy into it. That borrowed money drives prices higher. Higher prices attract more buyers, many of whom also borrow. The assets keep rising. Everyone feels like a genius. The early investors are shown enormous returns on paper. New money floods in. This is the phase that feels like the future arriving. But here's the mechanical problem. All of that borrowed money has to be repaid with interest. For that to work sustainably, the companies receiving the investment need to generate real profits. Profits that exceed the cost of the debt used to buy them. And Dalio's specific concern about AI companies right now is precisely this. The spending on AI infrastructure, the computing power, the data centers, the talent, is consuming capital at an extraordinary rate. And the profits that were supposed to justify that spending have not yet fully materialized. He put it plainly. AI is eating everything. The resources flowing into it are enormous, and if the revenue and profit do not follow at the pace the market is pricing in, the whole dynamic reverses. The people who borrow to buy start feeling the pressure of interest payments on assets that are no longer rising fast enough to cover those costs. They begin to sell. Quietly at first, then less quietly, and that selling creates the very conditions it was trying to escape. That is how bubbles burst, not always in a single dramatic crash, more often in a slow unwind that accelerates until it becomes impossible to ignore. And here is something that makes the current situation more fragile than most people realize, because it connects AI valuations to a risk that has nothing to do with technology at all. The United States government is currently spending roughly $7 trillion a year while taking in closer to $5 trillion. That gap is financed by selling debt to domestic and foreign buyers. But those foreign buyers, who hold about a third of all outstanding U.S. debt, are increasingly viewing that debt through a different lens. They see geopolitical risk. They see a debtor nation whose political system makes structural reform extremely difficult. And some of them are quietly reducing their exposure. When foreign buyers become more cautious about holding dollar-denominated debt, the pressure on American interest rates increases. Higher interest rates increase the cost of all the borrowing that inflated AI valuations in the first place. The companies that raise capital cheaply to build AI infrastructure suddenly face a more expensive world. The investors who borrow to buy AI stocks feel the squeeze more acutely. And that pressure does not need a market crash to begin. It just needs rates to stay elevated long enough for the math to stop working. This is the connection most people never make. They are watching AI as an AI story. Dalio is watching it as one pressure point in a much larger financial system that is being stressed from multiple directions simultaneously. Any one of those pressures might be manageable on its own. Together, they create the kind of fragility that looks fine right up until it does not. But here is where this conversation takes a turn that most financial commentators are not making. And once you hear this, you cannot unhear it. This is the China factor. And it does not just add to the risk Dalio is describing, it changes the entire foundation of the argument. Here is a single assumption that every major AI investment in the Western world is built on. Write this down if you need to, because it is the load-bearing wall of the entire AI investment thesis. The assumption is that AI will generate massive profits. That is it. That one assumption. Companies that build AI will charge for it. They will have pricing power. They will create competitive moats. Investors will get paid back through those profits over time. Every valuation, every price to earnings multiple, every analyst projection for every major AI company, it all rests on that single assumption being true. Now, what if a major competitor decided that assumption was wrong? Not that AI would fail, but that profit was simply the wrong goal for it? That is exactly what is happening in China right now. And Dalio raised it explicitly. The thinking that Dalio points to in China is that AI should function more like electricity or running water, something that should be universally available, cheap, or even free, because the national benefit comes from maximum usage and maximum productivity, not from any single company extracting profit from the technology. Some powerful voices in China believe the right model for AI is open source, widely distributed, essentially free. Now sit with what that means for a moment. If Chinese competitors are offering artificial intelligence capabilities that approach the level of American companies, and Dalio was explicit that they are not far behind, but offering those capabilities for free or at dramatically lower cost, what happens to the pricing power of Western AI companies? What happens to the profit margins that investors are currently paying enormous premiums to own? This is not a theoretical risk sitting somewhere in the distant future. It is already beginning to shape the competitive landscape, and the companies most exposed to it are exactly the ones that carry the highest valuations and are most widely held by everyday investors who believe they are simply buying into the future. This is why Dalio's warning is not just about a bubble in the traditional sense. It is about a structural pressure on AI profitability that the market may not be fully pricing in. The bubble could deflate not because people lose faith in the technology, but because the profit expectations built into current valuations turn out to be wrong. Not because the technology failed, but because the competitive pressure made those profits impossible to achieve. Let us talk about the historical parallel Dalio draws most directly, because it is the clearest map we have for what might come next. In the late 1920s, there was an extraordinary wave of new technologies: radio, automobiles, electricity infrastructure, telephone networks. These were genuinely transformative. They did change the world, and investors poured enormous capital into the companies built around them, convinced they were buying the future. They were right about the future. They were wrong about the timing and about which companies would survive to capture the value the technology created. When the correction came, it was severe. Most of the companies people had bet on did not survive in the form investors had imagined. The technologies kept going. The companies, for the most part, did not. Dalio has said this is the norm, not the exception. A very small percentage of companies in any transformative technology wave end up capturing the majority of the long-term value. The problem is that during the bubble phase, money flows into nearly everything with exposure to the technology, not just the future winners. By the time it becomes clear which companies those are, most of the losses have already happened. So here is the question that matters practically. And drop a comment if this thought has crossed your mind recently. If you genuinely believed there was a meaningful chance that the AI-heavy portion of the market was going to correct significantly in the next year or two, not collapse entirely, but correct meaningfully, would anything about your current portfolio change? Most people, when they actually sit with that question honestly, realize the answer is yes, and then they realize they have not done anything about it. That gap between what you believe and what you have done is exactly where financial damage accumulates. So what does Dalio say about the other side of this? About positioning rather than just risk. The first thing he is clear about is this: the goal is not to predict when the bubble bursts. Nobody knows that. Not Dalio, not anyone. The goal is to structure your situation so that when it does, whenever that is, you are not forced to sell at the worst moment. You are not leveraged into positions that create pressure on you. You have enough stability in your overall portfolio that you can wait or even act when others are panicking. That is a different mindset from trying to time the market. It is about building resilience rather than chasing a prediction. The second principle Dalio returns to consistently is hard assets, and gold specifically. His reasoning is not sentimental, it is structural. Gold cannot be printed. Its supply is essentially fixed relative to the pace of the global economy. It does not depend on any institution's promise to honor it. And when governments are carrying the kind of debt loads that exist right now, levels that historically have been resolved through some form of currency devaluation rather than genuine repayment, assets that sit outside that system carry a kind of protection that paper assets simply do not. He said directly that even a portfolio with no particular view on gold, even one that thinks gold might decline from here, benefits from having somewhere between 5 and 15% in it purely because of how it behaves when other things go wrong, not as a bet, as a counterweight. Third thing, and this is the one most people overlook entirely, is liquidity. Dalio draws a sharp distinction between wealth and money. Wealth is your house, your stock portfolio, your business. Money is what you can actually use, spend, and deploy when conditions change. One of the defining features of a bubble period is that paper wealth expands dramatically while real liquidity stays tight or gets tighter. The people who benefit from the correction, the ones who buy what others are forced to sell, are almost never the ones who were most aggressive during the run-up. They are the ones who are patient, who were not overextended, and who had real cash available when the moment arrived. That positioning is built before the event, never during it. There is one more dimension worth addressing. Dalio has spoken at length about the broader macro context surrounding all of this, the debt cycle, the wealth gaps, the political pressure building around wealth taxes in multiple countries. He has pointed out that the fear of wealth taxes alone can drive people to move out of appreciated assets and into cash. That selling pressure does not need a market crash to begin. It just needs enough uncertainty about policy direction to make people feel that holding inflated assets is riskier than it was. When you add that dynamic to the existing pressures, the profitability questions, the China competition, the borrowing that inflated valuations, you start to see a picture where the risks are not independent, they compound. One concern makes investors more sensitive to the next. Each individual factor might be manageable. Together, they create a more fragile system than the daily movement of markets makes visible. Dalio has spent 50 years studying exactly this kind of fragility, not to predict precisely what happens next, but to ensure that whatever happens next, his position can withstand it and potentially benefit from it. The question for everyone watching this is a simple one, not what Ray Dalio will do. What will you do with what you now know? The technology is real, the transformation is real. The companies built around it may or may not survive to capture the value the technology creates. The historical pattern on that question is not ambiguous. And the competitive pressure from a country with a fundamentally different view of what AI profits should look like adds a dimension that the market may still be underestimating. None of this is a reason for paralysis. It is a reason for clarity, for knowing what you own, why you own it, and what conditions would change your thinking. That clarity, more than any specific prediction about when or how, is what separates the people who protect wealth through difficult periods from the people who look back afterward and wonder what they should have done differently. If something in this video changed how you were thinking about your portfolio or raised a question you had not considered before, put it in the comments. Not because there is a simple answer waiting, but because asking the right question clearly is almost always the first step toward making a better decision. And if you want to go deeper on how Dalio thinks about protecting wealth through the kind of large-scale economic shift he believes is coming, the next video continues exactly that conversation.